Thanks, Bob. For the first time in about a decade, interest rates have gone up. ABC 7's Rebecca Fernandez joins us now with details on why we're seeing higher numbers and what that could mean for us, the consumer.
Alan, that rate hike is not a huge amount, but that 0.1 or 0.2% raise can affect our everyday spending and saving.
First off, why are interest rates moved up and down by the Federal Reserve? Well, it's to balance out the economy, since all financial institutions will follow the central bank's rate. And since we've had record low rates since the 2008 recession, experts say it was only a matter of time for this to happen.
When you have 0% interest rates, that can cause an economy to grow too quickly. It can cause an economy to overheat. And so by increasing the interest rate, what they're trying to do is they're trying to kind of balance growth. They're trying to have the economy grow, but not at a rate that's so quick that we end up going off the rails.
So what does that mean for us? When we have increased interest rates, the price of borrowing money is now higher.
Ideally, we're going to borrow less. What does that mean? We're going to spend less. So we're not going to keep spending in the economies, which promotes retail and going out to restaurants and movies and buying big ticketed items as far as cars and homes and, maybe going back to school, depending on all of these interest rates. That's how it affects it.
It's that last part where we'll see the impacts the most, on big loans like buying a car or student loans.
You're going to think twice. Do I want to commit, or do I want to pay 5, 6, 7, whatever the percentage is on that loan? And a lot of times people are going to say, well, no, because we've been spoiled. We had such low rates for a good amount of time.
But the market that is already feeling that rate hike is the housing market.
I think it's the most impactful on first-time home buyers.
Mortgage rates are being tested. According to lenders, the monthly payment on an average home is now 15% higher than it was a year ago.
Same price house a year ago is going to be more expensive today, so that immediately cuts into the buying power of a first-time home buyer. But secondly, prices seemingly keep going up, especially in that segment of the market.
Experts say interest rates are also definitely playing a factor on refinancing.
Most people have lower interest rates than the market rate today. So generally people are not going to refinance to lower their rate. But there certainly are other reasons people might refinance that can make a lot of sense if they want to do renovations on their home or pay off some high interest credit cards, or if they have the type of loan that may change at some point in the future. So, we certainly still see refinances, but interest rates have most certainly cut into the volume of them.
And while this all sounds like spending is going to be limited, financial experts tell us it's not something to be too concerned about.
When the Fed decides to move rates, that's a positive. People don't realize that all the time. That's a positive because the Fed says, okay, economies are good, people are making good money, and we can afford to raise the rates and not disrupt too much.
They are expecting interest rates to continue increasing, but little by little, until the economy balances out once again. In Venice, Rebecca Fernandez, ABC 7, your Suncoast News. Back to you, Alan.